You ever look at $100 bill and just wonder, could this thing become 1,000? Maybe even 10,000? It sounds a little like a daydream, right? Well, in this explainer, we're going to break down exactly how that journey could be possible. We're diving into the world of investing, and it all kicks off with that one single $100 bill. So let's just get right to it. The big question, can you actually turn $100 into 100,000? And the short answer is, yeah, you can. But look, there's no magic wand here. It's all about a journey. And that journey is all about understanding this constant tug of war between risk and reward. It's about making smart moves over time. So let's take on that challenge. So how are we going to do that? Well, we're going to walk through 8 different ways you can put your money to work. We'll start at the very bottom with the safest, most cautious options, and then we'll climb up step by step toward the strategies that have the biggest risks. But also, you guessed it, the biggest potential rewards. And this whole idea, we're going to call it the risk ladder. It's like a super fundamental concept in all of finance. Think about it. The lower the risk, the safer your money is, for sure. But the potential for growth is also pretty small. As you start climbing that ladder, taking on a little more risk, the potential for a much bigger payout starts to grow right along with it. It's that simple. Okay, so let's start at the very bottom of the ladder. Step 1. And look, this part isn't about hitting the jackpot overnight. Not at all. This is all about protecting what you already have. It's about building a really solid, safe foundation for everything else we're going to talk about. And this slide, wow, this really shows you why we need to do something. You might think, hey, the safest thing is just to stash my cash under the mattress, right? But here's the kicker. Inflation. You know, that slow, steady creep where everything gets more expensive? Because of that, the US dollar has lost something like 95% of its buying power since 1913. Think about that. What you could buy with $1 back then cost you about 5 cents today. So if you're just holding cash, you're actually slowly losing money. Okay, so our first 2 rungs on the ladder are all about fighting that slow leak. First up, a high-interest savings account. Super low risk, a 1 out of 10. But let's be clear, this isn't about getting rich. This is your emergency fund, your own no money. Then you've got gold, which people love to call a safe haven. A little more risk, a 2 out of 10. Its main job? To act like a shield against that inflation we were just talking about. It's about holding its value when other things might be going down. All right, foundation is set. It's solid. Now it's time to actually start climbing. We're moving on up to strategies for steady, passive growth. And what I mean by that is ways to make your money work for you without you having to mess with it every single day. And honestly, this is probably the best way I've ever heard an index fund explained. Just picture a bag of Haribo gummy bears. You don't have to sit there and pick out the best ones, right? The factory already did that. They put all the most popular flavors into one bag for you. Well, an index fund is the exact same thing, but instead of candy, it's a bag of the top companies. Think Apple, Microsoft, Amazon. You get a little piece of all of them in one go. You're instantly diversified. It's so simple, but so powerful. And the risk is still pretty low, just a 3 out of 10. And hey, if you're still not sold on that, get this. The investing legend himself, Warren Buffett, was so sure about this simple idea that he made $1 million bet. Seriously, he bet that a boring, basic S&P 500 index fund would make more money over 10 years than a collection of funds handpicked by the so-called smartest pros on Wall Street. And guess what? He won. It's just an incredible real-life story that shows you sometimes simple is just better. So have you ever thought, man, I'd love to invest in real estate, but then you remember you don't have, a few $100,000 lying around? Well, that's where something called a REIT comes in. That's REIT, for Real Estate Investment Trust. Basically, you're buying a tiny slice of a huge company that owns and manages big properties, like office buildings, shopping malls, apartment complexes. You basically get to be a landlord and collect a piece of the rent money, but without any of the headaches like fixing a clogged toilet at 2 a.m. So, how do these 2 passive options really compare? Well, let's look at the numbers. This chart shows the 10-year average returns leading up to 2019. You can see the S&P 500 did pretty well, a solid 7%, but then look at the REITs. They actually did even better, averaging 10%. And a big reason for that is that REITs legally have to pay out most of their profits to shareholders as dividends, so you get this nice, steady stream of cash. They're both really solid choices on the same level of our risk ladder, just with a slightly different flavor. Okay, time to climb again. We're moving into a whole new territory now. This is the hands-on section. This is where what you know, your personal expertise, starts to become a really big deal. This is where your knowledge can literally turn into profit. So on this rung, we've got two different flavors of hands-on. On the left, you've got buying and selling stuff, flipping things. This is where your specialized knowledge, maybe it's Pokemon cards, maybe it's golf clubs, lets you buy low and sell high. It's a hustle for sure, and the key thing to get is that your knowledge is the asset. Then over on the right, we take a pretty big jump up the risk ladder to picking individual stocks. See that risk score? 6.5 out of 10? Yeah, the potential rewards can be way bigger, but your success now depends on this really tricky cocktail of skill, research, and, let's be honest, a whole lot of luck.
And speaking of luck, you have to hear this. It's a famous story. Someone came up with this idea of having monkeys, yes, literal monkeys, throw darts at the stock pages in a newspaper. And the results were just mind-blowing. The random stocks the monkeys picked actually did better, on average, than the stocks picked by super smart, highly paid fund managers. The lesson here is pretty simple, right? When you're picking single stocks, you can do all the homework in the world, but you can never, ever forget the huge role that pure random luck plays in the whole thing.
All right, we are getting near the top of the ladder now, and I need to be super clear about something. We are leaving the world of investing, and we're entering the world of speculation. Some might even call it straight-up gambling. The potential rewards up here, they're off the charts, but the risks, they are just as massive. And nothing illustrates this better than something like Bitcoin. We're going to put this at a 9 out of 10 on our risk scale. Just look at these two completely different stories. If you put $100 into it back in 2015, you could have had around $5,000. Amazing, right? But if you put that same $100 in at the very peak in late 2017, just 1 year later, you would have had less than $17 left. That is the definition of a wild ride. And that brings us to the very, very top of the ladder, the final rung, the ultimate gamble, a perfect 10 out of 10 on the risk scale. The lottery. I know people see it as buying a dream, but if we're looking at this purely from a financial point of view, it is without a doubt the riskiest place you could possibly park your money. Just to prove the point, the source for this explainer actually ran a little experiment. They went out and spent $100 on scratch-off tickets. And what happened? Well, as you can see, they got $50 back. Now, you might think, hey, getting half your money back isn't so bad. But in the world of investing, that's what we call a negative 50% return. You lost half your money instantly. And the reason why is simple. The odds are just staggering. Your chance of hitting the big jackpot is something like 1 in $14 million. To give you some perspective on how crazy that is, you are literally 4,000 times more likely to win an Academy Award, an Oscar. It's just not gonna happen. So there you have it. We've climbed the whole ladder, all the way from the safety of a savings account to the pure chance of a lottery ticket. And at every single rung, we saw the exact same thing, right? Risk and reward. They are always, always tied together. Which brings us to the last question. And honestly, it's the most important one. And it's not for me to answer. It's for you. After seeing all this, if you're holding that $100 bill in your hand right now, where on this ladder are you going to take your first step?